At the time of this video, Warren Buffett is the 5th richest human on the planet, with a net worth of $104 billion. To put this into context, if this was cash in a bank, it would generate over $5.2 billion in interest in 1 year. You would need to spend over $14 million every day just to use up the interest on the capital. Even after tax, we are still talking astronomical sums. In this video, I'll reveal my 9 favourite Warren Buffett quotes which have helped me the most along my own investing journey. Number 1. Someone is sitting in the shade today because someone planted a tree long ago. In this saying, Buffett is highlighting the importance of long-term thinking. I've been growing my own portfolio for over 14 years. I didn't put one huge lump sum in at the start as I simply didn't have it. Instead, I drip-fed spare money in each month over many years and reinvested the dividends to allow the portfolio to snowball. At the end of 2009, the portfolio was generating an average of £8 a month, and at the end of 2022 it was producing well over £1,000 a month. But it took time to achieve this. You have to be patient. Number 2, be fearful when others are greedy and be greedy when others are fearful. It can be extremely difficult to go against the crowd, but few quotes provide as much insight into the mind of Warren Buffett as this one. Buffett reminds us that humans are naturally irrational, and many in a group often do irrational things. This is why large market swings are often based on the whims of traders. Fighting the urge to follow the herd mentality into a stock will often pay off, while running into a trend will often lead to disaster. It's never a good idea to try and time the market, and I always put dividends I receive straight back in regardless of market conditions. When the market is rocketing, however, I tend to put a little less new money in and save some instead. When the market is falling heavily, I use some of this saved money and put in a bit more than I usually do. Buffett is said to always have at least $20 billion on standby to snap up bargains when they emerge. In September of 2020, the shares of HSBC fell sharply because of a banking scandal. I used this as an opportunity to buy more shares. On a previous occasion, I did the same with Shell shares. Here is a graph of the share price since 2010. The shares had been fairly stable at around £22, but then something happened. The price of oil plunged around the world because of oversupply, mainly because of the shale gas revolution. The price of Shell plunged 50%, but it's a cyclical stock and it eventually recovered. Because I'd been buying low, I amplified my gains, and it wasn't long after that another opportunity presented itself during the global pandemic. Because I'd been loading up with shares when they were cheap, the total value of my portfolio increased significantly, and I was doing exactly the same with BP. Barclays also crashed during the pandemic, and I bought multiple times when they were low. So too did the US market, and I used this as an opportunity to buy an S&P 500 ETF for the very first time. It recovered from this drop just 5 months later. Number 3, look at market fluctuations as your friend rather than your enemy. Buffett knows that the market is going to be volatile and that fluctuations represent opportunities if you take the emotion out of it. Here are 2 hypothetical scenarios to show how much more money you can make in a volatile market through regular investing. In scenario A, let's assume we invest in a company at the start of the year. It has a share price of £1 and we drip £500 in each month. Over the course of the year, the share price rises to £1.10. At the end of the year, we would have a gain of £258. I'll ignore other costs for simplicity. Now let's look at scenario B, where we introduce some volatility. The shares start at £1, but this time the share price crashes. But we carry on as before, always buying £500 worth of shares. Because the shares are now cheaper, we get more shares for our money each time. Now let's assume the share price recovers and, just like scenario A, finishes the year at £1.10. Now you can see on the right hand side of the screen that because we were able to buy a higher number of cheaper shares, our total gain for the year is over 10 times what we achieved in scenario A. Now I've made a lot of assumptions here, and shares rarely crash and bounce back so quickly. And of course there is no guarantee that they will ever recover at all. But it does perhaps illustrate that over the long term, if you can ride out volatility by investing regular amounts, it really can make a big difference. Here is a graph of the FTSE 100 since the 1980s. plenty of volatility, but the trend is upwards. If you remain invested and drip feed money in, then as Buffett says, market fluctuations become your friend, not your enemy. Number 4, we enjoy the process far more than the proceeds. Investing really is for the long term. Some say they haven't got enough money to invest, but these days you can invest with small amounts and buy fractions of shares. We all have to start somewhere, and when I started, my first target was to achieve enough passive income to be able to afford to make a cup of tea a day. As time went by, I aimed towards higher targets. This kept me motivated, and I'm still as enthusiastic about the process now as when I first started. The portfolio size doesn't actually interest me, but the dividends do. I don't look at the top of the mountain. I'm more concerned with the next step along the journey. Number 5, if you aren't willing to hold a stock for 10 years, don't think about owning it for 10 minutes. Buffett is not a day trader. He believes in buying companies he thinks have significant value and strong earnings and never selling them. In my own portfolio, I've held the following companies for over a decade. They are all members of the FTSE 100, which represents the largest UK listed companies by market capitalisation. They have strong balance sheets and economic moats, meaning they are virtual monopolies and should hopefully continue to do well and churn out streams of reliable dividends far into the future. They are also global giants, earning much of their revenue from around the world. Shell, for example, only earns 5% of its revenue from the UK. Number 6, only when the tide goes out do you discover who's been swimming naked. What Buffett is saying here is that in a bull market where everything is going up, everyone feels like a stock market genius. It doesn't matter what you buy, as everything seems to be going to the moon, and there are endless people giving stock market tips. However, when difficult times come along, some companies will be more resilient than others. Those with high debt and poor balance sheets will struggle and their share price will fall. I have found in tough times it's the companies which may seem dull and boring, like the utilities and consumer staples, which are often very resilient and are called defensive stocks for a reason. Number 7, chains of habits are too light to be felt until they are too heavy to be broken. This famous saying has inspired me to invest regularly no matter what the market is doing. I also reinvest the dividends almost immediately I receive them. I set myself dividend targets along the way, and I never forget to have a small celebration when a next dividend target is reached. This all becomes habit forming and eventually very difficult to break, especially when the rewards seem to accelerate over time. Number 8, the most important quality for an investor is temperament, not intellect. Buffett is saying here that a disciplined investor is a wealthy investor because they have learned that market fluctuations are normal and that patience pays off. In this quote, Buffett touches on the psychological nerve of most investment failures. The irrational nature of humans means that many are tempted to make trades when they think the market is working against them. In contrast, the well-tempered investor learns not to watch the market. This is the person that ultimately ends up reaping most rewards over the long term. Number 9, it's never paid to bet against America. We come through things, but it's not always a smooth ride. In the 20th century, the US has endured 2 world wars, the Depression, a dozen or so recessions and financial panics, oil shocks, a flu epidemic, and the resignation of a disgraced president. Yet the Dow Jones Index rose from 66 to 11,497. And what about my own portfolio, which I've been growing for the last 14 years? Since I started, it's had to endure the financial crisis, the Dubai debt crisis, the European debt crisis, the flash crash of 2010, the stock market corrections of 2011, 15 and 16, various elections, Brexit, and just to top it all off, a global pandemic, which had one of the worst effects on my portfolio of all, crashing it 26%. At the time, the value fell from 230k to 170k, but I didn't panic. Instead, using the Buffett principles already mentioned, I saw great opportunities. At the time of this video, my portfolio stands at 390k. Now let's revisit the first sentence of that last quote. It's never paid to bet against America. Well, last year I actually put more into an S&P 500 ETF than any other share. The ticker code for this one is IUSA. You get the complete index in just one share. This screen shows the biggest holdings you would have. The ongoing charges are a tiny 0.07%. Please hit the like button if you found this video helpful. See you next time and happy investing.